You are now listening to the Supply Chain Secrets Podcast with Brian Most and Don Davis.
Well, hi, everyone. I'm Brian Most, SVP of Retail Strategy at NYSHEX and former VP of Supply Chain at Walmart.
And I'm Don Davis. I'm the Senior Vice President of Carrier Strategy here at NYSHEX and former executive of Hapag-Lloyd and CMA CGM.
And we're back again with our podcast called Supply Chain Secrets. Today, Don and I have the pleasure of talking to a very special guest, and actually a current NYSHEX member, Mr. Ryan Lockwood. Ryan is the Senior Vice President of Finance at CarParts.com. Now, CarParts.com is an online provider of aftermarket auto parts, including collision parts, engine parts, and performance parts and accessories. The company's headquartered in Torrance, California, and was founded in 1995. They sell 1.2 million SKUs, including 58,000 private label. Ryan, that's a big responsibility, and welcome to the show.
Thank you guys for having me. We love working with NYSHEX, so it's exciting to be a part of this podcast.
Awesome. Well, I'm sure people want to know a little bit about you, your background, how you got to Car Parts, and just how Car Parts has been doing over the last couple of years.
Sure, yeah. So as you mentioned, I'm the Senior Vice President of Finance, and prior to this job, I was actually on the investing side. So I was head of fixed incomes for a $3 billion firm. And then prior to that, I was working in real estate. I managed about $300 million for a family office. And then prior to that, I worked at CarMax on pricing and inventory acquisition. So when David asked me to join, he said, hey, I need a guy that really knows capital markets because he's going to be talking to all the bankers. He's going to be talking to all the investors, analysts. So he needs to know capital markets. But I also kind of need a guy that can do real estate because we're opening a bunch of DCs. And it would be helpful if he had auto experience. And I said, I happen to have some of those. So it was a great fit. And as I mentioned in another interview, when someone asks you to get on a rocket ship, you don't ask, where's your seat? You just get on. So it's been very exciting for me to be here, and this company's been growing quite well.
That's exciting. That is really great to hear. And I'm sure everybody, wants to hear just how, you as an online retailer have managed through the pandemic. Everybody has had kind of a different experience and approach. I'm sure people would love to hear how Car Parts has been doing and maybe some of the things you learned throughout the pandemic.
Yeah, so the pandemic obviously has been an accelerator for a lot of e-commerce. For us, I don't think it was as direct of a contribution as people think. So for us, our big bottleneck on revenue growth is our DC footprint. And we actually opened our Las Vegas DC in January. And then we were up about 40% on private label January, February, which was pre-pandemic. And then the pandemic hit. And then we continued to grow. But we always competed against the big four guys, AutoZone, O'Reilly. They were open, they were an essential service. So we always competed against them. But I will say some people maybe that didn't feel comfortable with e-commerce taught themselves e-commerce because of other venues, and then that helped lead them to us. And we're much cheaper than competitors. So to get our name out there and let people know they can get auto parts for 60% cheaper than they used to get it with the convenience of being on their couch, that was very helpful. As far as, what did we learn from the pandemic? We definitely were already flexible before, but it really, I think, struck home how important flexibility is. So things like working from home or things like not having great historical results to look back to. And so for viewers who don't know, our company's in a turnaround. So a new CEO, new CFO came in early 2019. So already 19 was a transitionary year. Then 20 is a pandemic year. So you can't say, well, this is what a normal market looks like to extrapolate and make decisions. You're making decisions with no great historical data as well as no great data about what an environment we're in should look like. So that's probably the two biggest challenges we had. But luckily, we have great teams, great data science, great people on the supply chain, and we've done quite well to mitigate a lot of the issues that were coming through.
So, with the pandemic, I think one of the biggest impacts has been on the ocean shipping side. That we know that, early on there was this big blanking of sailings. Everything was shut down, and everything started to open up again. You saw services reinstated, and then just came this tsunami of freight through from Asia. But there's been so much unreliability. There's been things like the Suez. There's port shutdown in Yantian, congestion in LA, and it's just wreaking havoc on the supply chain. Can you talk a little bit about how you've been impacted? I mean, costs are obviously a component, but what other things are impacting you when the supply chain is so disrupted?
Sure, I think that's a great question. Luckily on the Suez, we only had one ship that got stuck. Thank goodness. We predominantly don't ship through the Suez, but we still got hit a little bit. Um, it's been quite interesting because what we saw, we already had long lead times because predominantly our inventory comes from China, Taiwan, Europe. So then what ends up happening is long lead times got longer for everybody, and we were already trying to, the analogy I make is kind of shoot a bullet out of the air with another bullet, because we have these long lead times and we don't have substitutability in our business. If someone needs a right front headlight for a Ford F-150 and we don't have it, they don't say, just give me a control arm, or just give me a Camry headlight. We really have to have what the customer needs, what exactly when they come in to our website, versus someone that's buying a TV that says, I want a 75-inch TV. You don't have it. I'll buy a 65, an 85, a Sony, a Vizio. There's no real fall over conversion. So for us, having that inventory in stock and getting it replenished right before it goes out of stock is really more important to us in our industry than it is for some of our peers in e-commerce in other industries. So that was a big challenge. And what we ended up doing is just assuming we're going to need an extra 2 weeks on every single vessel coming in. So we built into our supply chain projections windows of safety, margins of safety. And then the other thing that was interesting is there were issues going all the way up to supply chain that we were not necessarily planning on until it happened, and then we had to book that in as well. So a good example is for brakes, we were delayed on getting brake pads because the brake pad manufacturer had pads, but the metal backing material was coming from somewhere else, and then he was delayed. So those delays from his supplier leads to our supplier, leads to us, and everything kind of is dominoes going down a hill. And so those are the major things that we saw that we had to really overcome. And I would go back to, again, luckily we have a lot of experienced people in data science, and we're able to try to do a better job of forecasting through technology what we really need to be doing to mitigate some of this risk. But there were certain unexpected challenges that kept popping up because no one had really experienced anything like this before.
Yeah, I've heard a number of stories about that. There's one piece that's missing to an individual item, right? It's like it's not the pad, it's the metal that connects the pad. And there's all these stories about that. And I think there's some sense of people are just like, well, hey, why don't you just order more? Is this what's driving it? Is it really demand, or is it the idea that I need to increase my supply because I have to prepare for disruption? Do you have any perspective on, is it more demand driven, or is it more that you want to just have more inventory in your supply?
So for us, it's interesting. It's a little bit of both. As we open new DCs, we obviously need more supply. And then also as we have if you look at the auto industry overall, for example, you're seeing new car prices hitting records, used car prices hitting records. And what used to be a new car buyer, he rolls down to a used car buyer. What used to be a used car buyer of a relatively new used car, he falls down to a more used car, an older used car. And what was somebody that was buying an older used car now says, I'm stuck, I need to repair this car. And you very logically, most people that sell a used car are not a charity. They're going to sell the car as is. They're not going to fix it up and then sell it. And then the person that buys it, though, that car is still new to them. They probably saved up a lot of money to buy that car. That's an important purchase. They want it to be reliable. They'll go get that car repaired, is usually the first thing they do when they buy a used car. So that's what we've been seeing is obviously, I believe that there's some tailwind there from demand of people needing to buy these parts. But also we have the tailwind of no one really knew who we were a year or two ago. So as more people figure out who we are and the value we bring, demand also rises. So there's a few factors, and both sides are squeezing that supply chain continuously.
Ryan, I think it's fascinating that kind of you as a finance guy know so much about like the supply chain and the ocean component of your business, which I think is incredible and great. But a lot of times over the course of my career, the supply chain and logistics stuff has been left to the transportation guys, and kind of the finance guys do their planning and things like that. You seem to know a lot about it. And I just wonder, have you always just wanted to be close to the different areas of the business, or is it just based on what's happened the last, year to year and a half, that's kind of got you more interested or more attuned to this side of the business?
So I have a little bit of experience in kind of everything from my prior job of doing investing. So I did investing for 10 years. I'm a CFA charter holder. And even though I was head of fixed income, I worked my way up on the equity side. So we had a lot of investments, in various shippers or a lot of actually more on the oil, like offshore drilling or oil services. So I do know how some of the booms and busts work. Obviously, it's different because you guys are not exactly commodity based, you're more economy based. There's no forward market, for example, but I do have ideas about how long it takes to get ships. I understand some ships will get cold stacked and then they'll come out. So there's certain things that I kind of get that maybe a normal finance guy that's only spent time in corporate finance might not know. But also, I do try and sit in. About 20% of my time is talking to investors, but 80% of my time is sitting in on a lot of meetings to learn about the business, to see how I can help from a strategic basis or apply some of my prior experience from my old job of, hey, I saw this company do this, it didn't work well, we should try this or try that. So I work well with all the teams. It's something I really enjoy, but I also have a little bit of experience that I brought with me from ancillary verticals.
Now, I think it's great, and I'm sure it's a huge addition to the team in terms of another diverse opinion or perspective or approach. And I guess that leads into how now you start to think about with your team, just future strategy and inventory types of initiatives, right? You kind of talked about, hey, we're having to add additional weeks to our transits or our supply. Do you foresee that happening, into the future for a period of time? I mean, we kind of hear this term now being called, instead of just in time, just in case, that whole thing. At some point, I think some of this settles down into whatever a new normal is going to be. But I just wonder how you think about future planning cycles. Can you even do 3 and 5 year planning anymore, or how are you talking with your team about approaching future planning and strategy, development?
I think that we always at this company, we always have a long-term plan. We always have a long-term vision, but we're not rigid about it. So we know what our logistic footprint should look like in 5 years. We know how much inventory that's going to demand, what will need to be in the system. But at the same time, we're always willing to pivot on what we're going to do. So I think that that's a really important thing in corporate planning is to not just because you put out a 5 year plan, it doesn't mean it's written in stone and the world changes. So even when we were looking, and this is on the other side of logistics, it's outbound, we would do a network study that says, yeah, FedEx, this is where you need everything to be to have these coverage ratios on 2 day, 1 day. And then the pandemic hits, and then your map changes. And then they start to get a little better, and the map changes. And then they start to get squeezed again, and the map changes. So you have to be dynamic in your planning. I think as far as what you mentioned on just in time inventory, it's almost like that's where we're headed now because of the pandemic, where we're doing a better job on our, again, going back to the no substitutability, we need to have those right parts exactly in stock, but we have obviously limited ability to bring over volume into the country now. So what we can do though to mitigate issues is, for example, Q1, our all our DCs were pretty full except for a brand new Grand Prairie, Texas DC. That was about 50% full going into the quarter, exited the quarter at 60%. But from a revenue utilization basis, so inventory basis, hitting a balance sheet side is about 50, 60% full. But from a utilization side, which is more on the income statement, it basically ran at about 90, 95% in Q1. So how did that happen? How is it possible you were only half full? We had the right stuff in stock. So again, going back to data science and our amazing supply chain team, they ordered the right stuff and they prioritized the right stuff and brought it over. So we had less, say, AC condensers in January and February because that's just not what's in demand. And we prioritized other things that are in demand in that quarter, like say window regulators or bumpers. So that's one thing that we can do to help. So it's not a long-term way to run a business is to kind of go season by season and only pick and choose exactly, but it is a way to get through the issue that we're in.
Yeah, that's really interesting. And I start to think about there's a lot of things happening in the supply chain side. And it sounds like you've done a lot in that space. But some companies are really trying to use their supply chain as a competitive advantage. And do you have any thoughts about that as a strategy? Is that something that you think can give some companies an edge over their
Yeah,
competitors?
for us, supply chain is our competitive advantage. So unlike a lot of our other competitors that are pure play e-commerce, the majority of pure play e-commerce competitors in our space are drop shippers. So what happens is they're buying from a guy who bought from a guy who bought from a guy who bought from a brand who bought from the supplier. So you think about all those layers of fees and all those markups that add zero value. Versus for us, the analogy I make is we're kind of like a Warby Parker for anyone that wears glasses or knows that space, where we're going to a factory, we go direct, we buy that product, we bring it over in containers with your help, and then we put it in our warehouse, we pick it, we pack it, we ship it. So there's no middleman, it's just us. And we're able to offer products, 60, 70% cheaper than competitors because we cut out all these middlemen. But the way we offer that value is by having a global logistics team, by having the ability to plan out containers, to make agreements with shippers, to put it in our warehouse. That's our warehouses that are run by our people, and we're doing everything except for really last mile. And so by having that, we can pass on a significant amount of savings to our customers. And it also gives us some insight into what's going on. So we saw the shipping issues really start to hit, middle of end of last year, versus I could see that some of our other competitors that are kind of the price takers, they're drop shipping, they didn't even know there was a supply chain issue coming down the pike. But because we are vertically integrated, we are paying attention to it. We saw this coming and we aggressively were buying inventory at the end of last year, aggressively buying inventory at the beginning of this year, because we understand, again, the substitutability. If you don't have the inventory, you're not going to win. So you might have to pay up, but it's better to have something and sell a little bit more expensive than have nothing and make zero revenue.
Yeah, that's interesting. So you have a different perspective. I mean, Bryan and I, we're two shipping guys. We've been in the industry for a long time. And, you bring a different perspective. And now that you've been exposed to the shipping industry and some of the challenges with the supply chain, do you have any thoughts on, your observations on things that are needed in the industry? I mean, what strikes you as that missing ingredients for
Yeah,
the
I think
industry?
there's three things in my mind. Is that number one is having a true partnership between the shipper and the carrier. And I think that in some cases we really try to look at this as a partnership. Uh, but I think sometimes it can be very uh, maybe confrontational, where when the shippers can take advantage, they're taking advantage. When the carriers can take advantage, they're taking advantage. And I think one way you get around that is kind of what you guys are doing, or having a binding contract where we say, hey, I promise to ship you this stuff. And I promise, and the other person says, I promise to carry it. And so it's wild that that it feels like these contracts were kind of never really strongly enforceable historically, where someone says, yeah, I'm going to ship a bunch of stuff with you. And then the containers don't show up. And now the carrier has to scramble to fill the ship, or vice versa now, where it's like, hey, I promised to ship this. Oh, well, I don't have room. And so it's not really fair to either party. It would be better if we had actual legitimate, maybe not long-term contracts, but intermediate term contracts that are enforceable, guaranteed with penalties, which is what you guys are doing. So I think that would be point number two in my mind. And point number three is, and this is my financial hat coming back on, is there's no futures market. So I'm used to something saying, hey, what's LIBOR going to be in 2 years? Well, I can look at a euro dollar contract and figure that out, for example. Or if you're a guy that's doing other transportation type things, I can say, hey, well, what's my fuel cost going to be? Well, I can look where crude futures are. And maybe it's not right. We all see the futures market swing around, but at least you can hedge in, for example. With this, there's no, I can't find it. I think that's what you guys are maybe trying to build, but there's no futures market where I can say, hey, what are shipping rates going to be this time next year? And if I'm okay with it, I'm going to lock them in. And if I'm not, maybe I'm going to wait. I don't think that exists, and it's something that really should, given the amount of dollars that goes into this shipping carrier relationship every year to supply the world with what they need. So it's an integral part of people doing their daily lives, because everyone just assumes when you go to the store the shelves are going to be full. But if the shipping routes break down and we have these issues, suddenly there's no cars, suddenly there's no computers, suddenly there's nothing. But if the carriers, I think, had more clarity on what their demand was going to be, then they would have had more confidence to have ordered ships 3 years ago, and they'd be hitting now when we need them, versus ordering them now and then they're going to hit in 3 years.
Yeah, I think that's a question on all the carriers' mind is like, how long is it going to last? And I can recall when I was on the carrier side in June of last year, that when the surge started, it was something that wasn't really well predicted, right? It just happened, and I think that's part of the challenge is how do you know what kind of demand, what does
Right.
demand look like? I mean, you can look at retail sales and certain indicators, but how much does that really tell you from a container shipping
Yep, I
perspective?
agree. And I think that's where having some kind of a futures market would help everybody because everyone can put their money where their mouth is, and then at least it gives you an indicator.
Ryan, I think some of the things you talk about are absolutely spot on, but it requires, change, right? It requires people to think differently and act differently. And even if sometimes the benefit seems so apparent, it's hard to kind of be one of those first movers. And, Donna and I try really hard for this not to be, a NYSHEX commercial, so to speak. But at the same time, since you're saying that there's a value in committed agreements and it is helping you become a competitive advantage, I think, committed agreements are still kind of early, right, in, their adoption. And so I just think about you and kind of the company just aggressively kind of pursuing change, bringing digital, components into, your strategy. What was it that caused you to say, hey, look, we are going to take that step. We are going to do a test and learn, a proof of concept. We're going to move in this different direction where some others may be wanting to take that step, but maybe haven't yet.
Yeah, for us, I think it's our stage of growth. We're not a mature company growing 2% a year. We're a growing company, growing very, very, very rapidly. So for us, it's a matter of supporting that growth. We have a lot of confidence in our growth. We have a lot of confidence in our supply chain, people to buy the right products, and we're trying to open. This year we opened a DC. Next year it's going to be a DC and a half because we're expanding Grand Prairie and opening Jacksonville. The following year, we're going to maybe open a 300,000 or 400,000 square foot facility somewhere in the Northeast. Following that, we're going to be opening maybe 1, 2 DCs a year, every single year for the foreseeable future. That's what our roadmap looks like. But to do that, we need inventory. And inventories, our CFO always says inventory is our oxygen. So it's our lifeblood. And for us, we would actually be fine paying extra if it means that we have some kind of certainty, right? And so I think that is within reason, obviously, but it really should be a symbiotic relationship between us and the carrier because I'm going to guarantee you a certain flow. I actually don't know if I should be paying a premium. I'm fine to pay something within reason. And it's very weird that it's hard to get that done. And obviously, I understand it's a volatile time. But coming from a guy that did fixed income and real estate and these other things, I'm used to a lot of contracts where say, hey, we all agree to this contract. It's pretty fixed. It's foreseeable. And I think that as long as your shipper from the carrier's risk perspective, if your shipper it has liquidity, they have growth, they have solvency. For example, we have 45 million cash, zero of debt. We're pretty good, to make sure that we execute on this contract. So I understand it's a case by case basis, but I think that that's going to be something that for us, our confidence comes from our balance sheet, it comes from our growth, and as far as for the carriers, hopefully they can see that and we can work something out that we can get what we need to continue our growth rate.
It's interesting you bring up that point about, recognizing that this is kind of an end to end, even though we're talking about a component of the supply chain with ocean, but it's this end to end solution. And there being trade offs, right? To say, hey, look, there may be a premium worth paying for predictability and reliability because the cost of non performance or unpredictability is so much higher than maybe what that small premium would be, to get the predictability. And I think that's a really, smart way to approach it because some people get so caught up in one segment of the supply chain and trying to leverage that, from a cost perspective, and then it affects them 2 or 3 times X down the line. The other thing about you talking about growing and scaling, it's one thing to have the inventory to meet customer demand, but I just wonder, is there also a play with technology and process where you can scale and also minimize, overhead costs and other things like that? Is that a component that you think about with digital type of solutions?
So for us, the way we would be able to get scale probably would be through adding automation. You were going to try and do automation in the Northeast, and then once we have a solid footprint across the country, circle back around and add automation. Jacksonville may have a very small amount of automation. So historically, the payback period and the IRR for doing automation was lower than just opening a regular DC and having people work in it. But there is an efficiency issue where machines can generally work faster. So there's a throughput as well. But as far as us getting growth, we committed or not committed, we kind of signaled to the street we believe we can do 20 to 25% revenue growth compounded for the foreseeable future here in the intermediate term. And so we can do that with our current plan of growing the footprint. As far as going above that, it would probably require really significant investment on the DC side and automation as well.
So I want to ask you a pretty direct question about your experience with NYSHEX and just get your perspective. I mean, you're a member. You have contracts with NYSHEX. Can you talk to our listeners to just give them some perspective on what your experience has been like working with NYSHEX?
Yeah, so I would say, the overall experience has been great. We are getting great fill rates, and it makes sense because people have skin in the game now. If I could give you one complaint, is that I can't do more business with you. So I actually was talking to Adam, and again, it goes back to our balance sheet. We have 45 million in cash, and I said, how much more can we put in escrow with you guys so we can get more containers and more guaranteed space, right? And I know you guys are working on it. You're growing. But that's like really the only complaint is I can't do more business with you because we again love that predictability and it helps us for our forecasting to say we know we're going to get these containers over here. All the rest of it, contract, spot, working with our carriers, we have good relationships. But again, it's a tough market out there without some kind of intermediary like you guys to guarantee us a certain fill rate. So if we could do more business, you have my phone number. You can call me, and I have the balance sheet, so we can work together and do more.
Well, I can assure you, we're working very hard on it, and I'm sure we're going to continue to talk about things, and I'm optimistic about the future.
So Ryan,
Yeah, I am as well.
when you talk about kind of fill rate in the committed agreements, I mean there is a cost component too, right? There's a landed cost certainty that comes with it. I just wonder in today's market with spot prices being so high and the market being so crazy, is there also a landed cost certainty component that you benefit from or you're able to leverage as a competitive advantage versus maybe some of the others?
Yeah, I mean, absolutely. Any certainty we can get around cost obviously helps us for our projections, and it also can help us for pricing because we really try to avoid large volatile swings in our pricing that we show to customers for obvious reasons. But if we know that our costs are going to grow at a certain rate, we can book that into how we push price increases through our website so they're more methodical and predictable and smooth that out so the customer is not seeing something in his cart jump 30%, which we wouldn't do anyways. We do our best to take care of our customers, but having that certainty would give us a lot better insights, both from the financial planning side, but also from our pricing strategy side that our data science team handles.
So I think we're getting towards the end of the show, and usually at this point, we've learned that our guests actually like to be a podcaster at some point, and we give them the opportunity to ask us questions. So Bryan and I, we've been at NYSHEX for a while. We've been in the shipping industry for a long time. Is there anything that top of mind that you'd like to ask us about either our point of view or anything that we've seen, or any thoughts on anything?
Yeah, so I think I have two questions. So the first question would be if you look at all your customers or people you've worked with in your history, and you think about the top 1% of shippers, what are they doing that we could learn from or emulate?
I guess I'll take that question from a carrier perspective, and I mean, I think it's one of those things you touched on earlier, and it has to deal with partnership. That and I think partnership can be something that's kind of thrown around out of convenience, and it's not just a word; it is a relationship, and it is a connection between two companies, and really looking beyond. I think this week or this quarter, this month, it's more of a long term connection to organizations, and I think those companies that have an openness and have a connection on multiple levels of both organizations, and not always looking for the lowest price. And I think that when you're a price seeker, it's a little difficult to say that my value proposition is service. So I think really demonstrating that hey, I understand, carriers are a for-profit business. They want to make money. And let's talk about a long-term strategy. And I think there's some companies that are able to do that. Now, not everybody can do it, obviously. Not all your customers you can develop that kind of partnership. But I think those that I would say are the top 1% have really built a strong relationship on multiple levels of the
Yeah, I
company.
mean, this is typically where I'd like to, challenge Don on his answer, but to be honest with him, I have to agree, right? This institutional kind of alignment on long-term goals and objectives is really, really important. And then, as he says, touch points all throughout the organization, and then this kind of mutual ability to measure right performance and success. Because if you are looking at it over a longer term horizon, there are abilities to kind of manage ebbs and flows. But if you're very transactional, it becomes this, oh no, they've got something, I've got to get it back. Otherwise, by the end of this agreement, they will have gotten the better end of this thing. But over the course of a long term relationship, there are things that you can share and find mutual benefit in. And I totally agree with what Don's saying. But the establishing a level of trust where there is transparency, data can be shared, and people can collaborate to work together is, I think, really what the top 1% do.
Got it. And then I guess my question number two would be, I don't know anyone that says that shipping is going to get better going into the holiday season. What can a shipper do to avoid Shipageddon 2.0, for example?
Well, yeah, that's a difficult question to answer because I think there's so much uncertainty around what capacity is going to look like. Are there going to be any ships coming online? Which it seems very unlikely that there's going to be this influx of capacity. So then it comes down to this uncertainty about demand, which we touched on earlier. Um, so I mean, my opinion is what one should do is really just communicate with your carriers and be as upfront as you can as far as what you're seeing and just getting a realistic expectation of what they can do. But I think it's important to stay in front of your carriers and just keep them informed of what your requirements are because things change and you never know. You've seen some extra loaders come into the market. I don't think that was necessarily known 2 or 3 months ago. So I think it's a matter of just staying in front of your carriers, communicating what your needs are. And sure, is everything going to get covered? Probably not. But if you're staying in front of your carriers and sharing with them what you're seeing, then I think you could be somewhere near the top of the list. Or like, aha, I remember I talked to these guys. I need to help them.
And I would say the same thing, short to medium term, it's about knowing as a shipper, what are your priorities? What are the most important things that you need to accomplish? And really putting your focus into making sure that happens and finding the right partners, obviously, to do it. Only because the opportunities that I think come your way are going to be ones that you have to make very quick decisions on. I'm hearing that, hey, look, this opportunity is
That's
available
right.
this
Yeah.
afternoon. I need to know within an hour or two. And if the answer isn't given, the opportunity has gone away, right? Only because you had to go get approval or try to align with other stakeholders. So I think prior alignment, prior prioritization, and stakeholder engagement is really, really important. And then I think kind of in the medium to longer term, knowing that there is probably going to be some type of disruption probably through the middle of next year, whether it's demand driven, whether it's labor driven, whether it's a COVID, variant driven. There's going to continue to be. And so this idea, as you said, of kind of pursuing a kind of a risk mitigation strategy with some of these committed agreements, you might not want to do it for all of your agreements, and you might not want to do it forever, but there's a period of time where I think it makes sense to say this portion of our business, we're going to try and get some assurity, even though there is a skin in the game for us. We're going to get assurity that this is going to be part of our inventory that will absolutely move at the cost or the price we've agreed. And I think that those are approaches that you could take if you haven't done it already.
We get those phone calls right now actually where it says, hey, do you want a space? You got to let me know right away. And that will go back to how great our team is, that they know and they answer, and that's part of how we're getting stuff over.
Yeah, that's awesome. All right, Ryan, any other questions you want to ask us? Last chance.
I think that was it, unless you want to tell me what rates are going to be this time next year.
Well, I think Bryan and I would probably be working somewhere else if we could predict that. Be making lots of money, but it's very Very challenging for sure. Well,
Yep.
Now this is a cheesy NYSHEX plug though, Ryan. I mean, we know what your rates are going to be in your NYSHEX contract for next year, right? That's the one guarantee we do have. So
Yeah.
there you go.
Perfect. Thanks, guys.
well, great. Well, Ryan, thanks a lot for coming on the show. I think it was a great show. Had a lot of fun having you as a guest. And for our listeners out there, don't forget, rate us, review us, hit that like button when you see us on social media or wherever you find our podcast, Apple, Spotify. So thanks again, everybody, and thanks for listening.
Thank you, guys.
Thanks for listening to the Supply Chain Secrets Podcast. Make sure to subscribe to the podcast on your favorite podcast network.